Welcome back to the fifth lessons in the option series. Today, what we're going to talk about is why people use options. And so, the goal of this video is to kind of show the practical reasons traders and investors use option, how each purpose changes the approach, and kind of like what type of traders each one is suited for. So, options aren't just about leverage or kind of like fancy charts. They're tools, right? And so, like any tool, how you use them matters just as much as what they are. And so there are three main reasons people trade options, and it's kind of like futures. The first one is to speculate, the second one is to hedge, and the third one is to generate income. Let's kind of break that down and like from a real world perspective. Speculation. This is the most common reason new traders enter the options market. You're placing a directional bet, for it to go up or down, or on an underlying stock, index, or ETF. And so what is the appeal? Well, you can control 100 shares of stock for a fraction of the cost. And so that means bigger percentage gains if you're right, but also a total loss if you're wrong. And so these are high risk, high reward trades, like buying out of the money calls before earnings or puts during market downturns. And so the key with speculation is that you're not trying to own the asset, you're just trying to profit from a move. Then there's hedging. This is the reason institutions and long-term investors use options. You kind of imagine this as you own 1,000 shares of a tech stock and you're worried about short-term downside, but you don't want to sell your shares. What you could do is you could buy put options as an insurance, and so if the stock drops, the put increases in value, offsetting your losses. And this is exactly what big funds do and pension managers do. What they do is it's not about making money, it's about limiting losses and stabilizing portfolios. Hedging is usually a cost center, not a profit center, but it's often worth it. Another one is kind of sounds the same, but it's called income generation. And so that is the third reason, and it's one of the most advanced, and is to use options to earn consistent income by selling contracts. And so this kind of includes strategies like selling covered calls against stocks you already own, selling cash secured puts to potentially like buy a stock at a discount, and using credit spreads to collect premium with limited risks. And so here you're not betting on direction, you're betting that something won't move too far or that time will work in your favor. Selling options means you collect premium up front, and you want that option to lose value so you can keep the difference. And so this strategy has like a high win rate, but it also carries obligation, which we'll cover in more detail later. And so why these matters? Well, your reason for trading options shapes everything. It shapes which strike you choose, whether you buy or sell, what expiration you use, and how you measure success. And so understanding your purpose helps you avoid kind of mismatched trades, like using long calls for income or buying puts when you're actually trying to hedge. So let's talk about the most aggressive and most common way people use options, which is speculation. And so this means you're taking a directional bet on the underlying asset. And so you think the price is going to move up or down, and you're using an option instead of buying or shorting the stock directly. Well, the question is, well, why? Well, because options offer leverage, and that is the main reason. You control, let's say, 100 shares of stock, sometimes with just a few dollars, instead of thousands. And so that gives you like a chance to make a larger percentage return than you would with shares, but it comes with a cost. And so if you're wrong, you could lose 100% of what you put in, and that's the high risk part. Okay, let's make an example. So let's say your stock is trading at $50. You think it'll rise on earnings, but you don't want to risk buying 100 shares for $5,000. Instead, you buy a $52.50 call option for $1 per share, which is $100 total. And so if the stock jumps $55 to $55, your call might double or triple in value. But if it stays flaps or drops, your option could expire worthless and you lose the $100. So this is kind of like, let's say, the heart of speculative trading is that like you kind of get like you risk a small fixed amount. You get like an outsized upsized potential, but you might be right on direction and timing. And so why speculators love options is that you can profit from short-term catalysts like earnings, news, Fed meetings, which is very similar to futures. You could trade both directions, both calls if bullish and puts if bearish. You could scale in with less capital than shares. And you can also target cheap contracts with big upside if move happens fast. And so this kind of trading appeals to retail traders, day traders, and anyone looking to turn small bets into large wins. But it's obviously high risk. And in futures lessons, we kind of showed how some traders reduce that risk using spreads and stop strategies. So if you want to go there, you could kind of learn the strategies. They're very, very similar and kind of go well with options. So the next one is hedging. So hedging with options is about protection, right? And it's not about prediction. And so it's a defensive move designed to reduce risk on a position you already hold. There is one way to hedge, and we've already covered that. This classic method is where you're buying puts as protection. That's like paying for insurance, and you accept the cost to cap potential losses. And so let's touch like a little more advanced technique, which is kind of very hard, but it's very good to understand. And this is called delta hedging. So what is delta hedging? Well, delta hedging is a strategy used by traders, funds, and even market makers to stay neutral as the price of stocks move. Remember that delta measures how sensitive an option is to price movement. And so if you hold a position with a net delta of plus 50 and the stock moves up $1, your position gains $50. That's great if you're trying to profit, but not if you're trying to hedge. And so with delta hedging, the goal is to neutralize that directional exposure. Let's give you an example. Let's say you sell a call option with a delta of plus 0.4, right? When I say plus 50 and plus 0.4, it's the same thing. It's plus 0.50 and plus 0.04. I kind of mix them around, but it's the same thing. Like plus 50 and plus 0.5 is the same thing. I mix them up. Anyways, let's say you sell a call option with a delta of plus 0.4. You're now short delta, and so you lose if the stock rises. To hedge that exposure, you might buy 40 shares of the underlying stock, which kind of balances out that risk. And so if the stock keeps moving, delta changes, and you rebalance your hedge. You rebalance your hedge by adjusting your stock position. And so that is delta hedging. It is maintaining a near zero directional bias in a consistently shifting market. And so who uses it? Well, I just mentioned it. Professional traders, option sellers, and institutions managing larger portfolios. And so they use delta hedging to smooth out profit or losses, to avoid directional bias, or stay neutral while collecting premiums from options. It's not something that most retail traders do day to day, but so understanding it helps why options price behave the way they do, especially near expiration or during high volatility. And so kind of the bottom line here is that whether you're hedging with puts to protect your portfolio or using delta hedging to stay neutral, options give you tools to manage risk intelligently and not chase the upside. And obviously the last one, the third major reason traders use options, and one of the surprises a lot of beginners, is to generate consistent income by selling options and not buying them. So when you sell an option, you're acting like the house in like a casino, and you're taking the other side of the trade, collecting premium upfront and profiting when time and probability are in your favor. And so the setup is, let's say you sell a call option for $2. You collect $200 upfront since options represent 100 shares. And so if the option expires worthless, meaning the stock doesn't rise above the strike, you keep the full premium. If the stock does move against you, you may have to deliver shares or take losses depending on how the position is structured. And so this is where like the strategy selection matters, because most income traders use methods that limit their downside while also maximizing consistency. A common income strategy could be covered calls, which is you sell calls against stock you already own. And so if the stock doesn't rise, you keep the premium. And if it does, you sell at a profit, which is great for flat or slow moving markets. There's also something called cash secured puts. It's you sell puts on a stock you'd like to own at a lower price. And if the stock drops, you buy it at a discount. If not, you keep the premium. And the last one I'd say is there's one that's called credit spreads. Is you sell a high premium option and you buy a cheaper one nearby to cap risk, and so you collect the net premium and profit if the trade stays within your chosen range. And so these strategies are used by everyone from conservative investors to advanced investors because they flip the edge, and so instead of needing a big move, you profit when the market does nothing. And so like the psychology of selling is that selling options is less about predicting movement and more about probability and discipline. You're stacking the odds in your favor. You got time decay, which works for you. You have volatility collapse, helps you. You know the maximum gain and often your maximum loss. However, it also does mean you must accept smaller wins more often and avoid like kind of overreaching. And so what one bad unmanaged trade can erase a month of gains, right? Because you could get cocky and you usually take very small profit, but if you take a big loss, that big loss can equal to a lot of small profits, and getting those small profits is very hard. So you got to be very careful, which is why risk control is very important, and it's honestly important in everything in income trading. So kind of the takeaway for income trading is that income trading flips the mindset. You're no longer betting on explosive moves. You're betting that things won't go too far or too fast, and you're using time decay as your ally, kind of. So now that you understand these three reasons traders trade options, which is speculation, hedging, and income generation, the question really becomes which one is right for you. Well, obviously the answer depends on a couple of things, and the three things I think it depends on is your goal, your capital, and your risk tolerance. If you're focused on growth and quick gains, you're likely in the speculation camp, right? This suits traders who are active, comfortable with risk, and don't mind volatility. You're betting on big moves, sometimes over just hours or days, and you're okay with the possibility of total premium loss in exchange for the chance to double or triple your money. If you're building a long-term portfolio, you may lean towards hedging. You're less concerned with daily traders, and you're more focused on preserving wealth, protecting gains, or reducing volatility. Options become a defensive tool. Sometimes you deploy when risk increases or even threatens your position. And if you're looking for steady returns, then income strategies might be your focus. Selling options for consistent premium rewards discipline, patience, and rule following. You won't hit home runs, but you'll take high probability trades, manage risk, and aim to win by stacking small edges over time. And so these routes suits people who are methodical, systematic, and okay with taking frequent small wins over big ones. I do want to say that you should remember that you can evolve. These categories aren't permanent. Many traders are start as speculators, and so what they do is they learn risk the hard way, and they evolve into income-focused traders. And then also others use a mix, selling options for income while buying puts for protection. And the key is to know why you're using options every time you place a trade, and the strategy serve your goal, kind of not the other way around. I hope this video helped on why you use options, and see you guys in the next one.